Hello, everyone, and welcome to this Tresle webinar. My name is Joel Keeler. I'm the CEO and founder at Tresle, and I'm very excited for this presentation today. Before we get started and introduce today's guests, I'd like to give a brief overview of what we'll be covering today. So this webinar is all going to be about business valuation. So the different reasons one would need it, how the valuation process takes place, as well as kind of debunking and looking at the truth behind some of the kind of common mistakes and myths associated with business valuation. So today's format is going to be a brief interview with our guests, and then we're going to transition to a Q&A with some questions that were pre-submitted from our social media channels, and then followed by a brief close. So joining us today is Darren Mize. He's partner at GCF Valuation Company, headquartered in Tampa Bay, Florida. GCF and its family of companies is the nation's leading provider in SBA-Compliant valuations. Simply put, GCF provides business valuation services for financial advisors, CPAs, attorneys, and small business owners. Darren brings 23 years experience as an accredited senior appraiser in business valuations for small to medium-sized company. Thank you so much for joining.
It's a pleasure to be here, Joel. Happy to answer any questions that you've got today. We're real excited about it.
Awesome. Thank you. Let's get started then. So maybe you could tell me a little bit about yourself, let the audience know about your background, how long you've been involved with kind of value in private companies.
Sure. Well, as you mentioned earlier, my brother and I actually started the firm back in 1997. So we've been at it now for going on 24 years. We started obviously as just a basic business valuation shop right out of Tampa, Florida. And we actually started doing our business with business brokers, catering to the local Business Broker Association in Tampa. And that's kind of how we got started. And once we got into that, after about a year or so, we started attending a few of the Florida-based brokerage conferences. And in one of those in Tampa Bay, we ran across a SBA lender at that conference. And that's how we got into SBA lending. So ever since then, obviously, the business has grown. Initially, my responsibility to the firm was really just to go out and attend those conferences and to bring in business and secure new clients. And my brother Steve was really the mastermind behind all of our valuation services. It got to a point, however, when we were getting so much business that I had to actually stop for a moment, pause, go out and get my accreditation in business valuation, which took about a year, and then started to help out with a lot of the work that was coming in the door. And since then, we've grown over time, most of which has really occurred in the last 10, maybe 12 years. But ultimately, my background was marketing and sales, a little bit of finance, but it took a good amount of time for me to get my legs under me when it came to business valuation. But that was back in 2007, so it's been a while.
Nice. Well, it sounds like you guys built a business over last the test of time. So you mentioned kind of SBA. So maybe you could tell the audience a little bit how you guys approach valuations. And I'm sure that's kind of an open question. We can kind of go whichever way it takes us, but specifically at GCF, how you guys approach it, and kind of part two, what does SBA compliant mean?
Okay. Well, approaching valuation is really not, it's not a complex term. I mean, anybody who's gone through the process of accreditation in business valuation knows that there is a very standard approach to valuing a business. Just like real estate appraisal, business valuation is no different. There's three approaches to value. There's cost approach, which is based on the balance sheet of the company that you're looking at. Market approach, which is based on comparable transactions of similar companies in the same or similar industries of same size. And then the income approach, which is basically the approach of risk and cash flow and marrying those two together to arrive at a value. So when it comes to the approach to valuing a company, we take the same approach with every business and every client that we come across. We go through the same process, the same methods, we gather the same information. Obviously, the questions are a little bit different from one company to the next based on the information that we're looking at. But when it comes to the approach itself, really, once you've gone through the process, it really comes down to making sure that the value is reasonable. And people have different perceptions of what reasonable is and what is not. But I think ultimately most people with no conflict, meaning no skin in the game when it comes to the value of the company that they're actually engaged by, can understand the difference between what's reasonable and what's not. The beauty of valuation when it comes to small businesses is privately held companies have an inherent amount of risk, so that when it comes to the reasonable test of value, you're only going to see price to earnings multiples go so high when it comes to business valuation on privately held small business transactions. And the second question you asked when it comes to SBA compliant, the SBA has a set of guidelines that every appraiser that works within the SBA industry has to follow. The basic and the most principled guideline of that is using the standard of fair market value. That represents a hypothetical transaction, cash or cash equivalent, willing buyer, willing seller, no compulsion to buy, no compulsion to sell. So essentially what that means in layman's terms is valuing the business on a standalone basis under the current ownership and current financial performance of the company prior to being acquired by a hypothetical buyer of that company. So in a simplistic format, that's really what that means.
Okay, great. Yeah. So you mentioned there's three different methods, I guess. Would you say that they're taken at the same time and maybe kind of looked at, or does it really depend on the engagement? In other words, do you maybe, take, cost approach, take comparable approach, and kind of look and average them, or how does that look in determining kind of, call it the most likely valuation? Are
Sure.
they kind of checks and balances for each other, I guess is a better way to put it?
Well, I think any appraiser, again, I use the term qualified appraiser. So anybody who's got an accreditation in business evaluation is going to tell you roughly the same thing, which is you're always going to consider all three approaches. That's where you start. Knowing that most businesses are not that asset heavy, the cost approach typically is going to be the approach that's used the least amount of times. That's based on balance sheet information, so assets. Obviously, depending upon the type of transaction that you're being engaged to value, if you're looking at equity, assets and liabilities, sometimes those numbers can be big, especially if you have a lot of cash or just a large amount of assets. But in most cases, you'll find that the cost approach is used the least. The only time the cost approach is going to be used is when you're dealing with a company that is asset heavy, meaning that you've got more value in the assets than you do in its cash flow.
So sorry to interrupt, but could you give like an example of
Sure.
that for the audience?
So, I'll paraphrase. Most small businesses are bought and sold at the enterprise level. That means that they're transferring only inventory, furniture, fixtures, and equipment from the balance sheet, cash flow from the income statement. Obviously, the customers go along with that, any goodwill. So when you're looking at a business, let's say that has $1 million worth of fixed assets in inventory, right? $1 million right off the balance sheet. And let's say that you've got on your income statement adjusted normalized discretionary cash flow of $200,000. We know that most small businesses are going to be bought and sold on a multiple of discretionary earnings of somewhere between 2.5 and 3. So even if you use 3 times 200,000, 600,000. So you've got a cash flow value of 600,000, but you've got a balance sheet value of $1 million. So in that particular case, you've got a situation where the balance sheet has more value than the income statement does. That's when the cost approach comes into play. So in those situations where you have lots of manufacturing companies, lots of distribution businesses that have a lot of inventory or a lot of fixed assets or both, you'll find that the cost approach sometimes will come into play, especially on those businesses that don't have a lot of inventory turnover. And you might find that from time to time. In those cases, inventory turnover will lead to low cash flow margin, and low cash flow margin leads to low cash flow, which leads to a lower value. So all of that kind of plays together in the cost approach. But you won't see that cost approach used that often unless you're faced with one of those businesses that is, in fact, heavy in assets. But I mean, from our experience, maybe 20% of the time, we'll incorporate that into our analysis. The market approach and the income approach are generally going to be the two approaches that are being used and weighted and considered the most often. But just like the cost approach, the market approach is also based on information that either is readily available or is not. So you're talking about comparable transactions of similar companies in the same or similar industry. Most people don't know, although most people who are involved in the small business transaction industry probably will tell you the same thing. Databases of small business privately held company transactions are hard to come by. So that means that because there's no requirement to report those transactions, unlike real estate that does require you to report those transactions, any small business sale can go by the wayside with no reporting at all. There's no government requirement there. So as a result of that, transaction databases are either one, hard to come by, or two, when you can and do find some data. It really comes down to the quality of the data that's being put into those transaction databases. So there are a few that we certainly use, some more than others. But if you can't find a good set of transaction data for the company that you're appraising, you just don't weight the market approach at all. There are times when you do find some good data. So, like I said before, you have to consider each approach and weigh the merit of those approaches to make sure that you're allocating the appropriate method and weighting. If you find some good data, you might find that the market approach can be anywhere from 50 to 100%. Usually averages somewhere 50 or less, but it depends upon the data. And then the income approach is typically going to be the one that you're going to use always, especially in those situations where the cost approach doesn't apply and the market approach doesn't provide you any quality data. In that case, there's nothing wrong with your 100% weighting on an income approach. That is, in fact, the nature of business valuation. It's the present value, future cash flow. So when in doubt, the income approach is the way to go.
Okay. Yeah, great. And that's very helpful in kind of understanding that. So you bring up a good point, which is, it kind of leads me to my next question, which is kind of comparables, I guess. So, company A and company B, can be in the same industry, kind of the same size, give or take, but have different, maybe the surface level looks the same, but have different attributes that correlate to a lower or higher valuation. Could you maybe touch on, some of the common attributes that would affect valuation?
Sure.
Some of them are, growth, some of them are customer concentration, those types of things, and maybe define the top ones and kind of why they're important.
Well, obviously, in valuing a business, when it comes to the market approach, what you're essentially doing is you're doing a side-by-side comparison of your subject company along with other types of companies that are either in the same line of business or in the same industry or both. And so when you're making those comparisons, what you're looking for, obviously, first is a financial comparison. How do they compare just strictly on a financial basis? Do they have more revenue? Do they have less revenue? Are they more profitable? Are they less profitable? So strictly based on financial comparison, that in itself may direct you to weight a multiple of cash flow at a higher level than you might compare to your subject company. So for example, if you're looking at a set of companies where the average cash flow margin is at 25% and your subject company is at 18%, you'll find that there's a little bit of financial risk there because you're not as profitable or strong as what your industry should be. So there are things that come into play there too. But that leads me to the next point, which is really comparison is still all about risk. So if you go back to the two key principles of value, you have cash flow, which is your financial strength, and risk, which is perceived differently from one person to the next. But there are a variety of risk factors that you have to look at, which obviously are considered as part of the income approach. But those same income approaches, when it comes to the risk category, can also apply in the market approach as well. So again, going back to the same idea, if I've got two companies that are right next to each other, they're equal in terms of size, in terms of financial strength. But one company has a key customer that generates 55% of revenue and the other company does not. You're going to have a situation where if the median average price to earnings multiple is 4, you might find that your subject company, because of that risk factor, may come in at closer to 3 or 2.5. So those are the areas where the appraiser is going to have to use sound judgment to make sure that they've identified the risk first and then determine how significant that risk is. If key customers, for example, are mitigated by the fact that that customer has been a customer for 25 years, you could make the argument that both customer and supplier are mutually dependent upon each other. So in those cases, you might find that the risk has been mitigated somewhat. So you have to take those sound judgments with you as you make these comparisons. And that can apply to anything. It could be economic risk. It can be key dependent or key, dependence on owner or owners, or any number of other things that the appraiser is going to look at. So, when it comes to the market approach, you're not, you're really looking primarily at the comparison of one company to the next, side by side. A lot of that risk analysis is going to come in the income approach, but if those risks do exist, you'll find that those multiples may vary from one to the next if both companies are otherwise likely equal.
Okay, yeah, that's great. Yeah. So I guess a big sticking point, I guess, for business owners, and maybe a little bit abstract and kind of get confused a little bit, are the difference between valuation and then ultimately the exit price or the final sale price, if they're setting out to get a valuation for the purpose of selling. So maybe you could touch, on explain the differences, if any, that exist between the two. And I guess specifically exit price, there can be various structures, and kind of beauty can be in the eye of the beholder in terms of the buyer's way to provide enterprise value. It can be all cash, it can be a mix of cash and equity, and obviously there are differences on the exit price front. So if you could explain the differences that exist between valuation and sale price, call it.
Okay, well, it's a common equation. So the difference between value versus price. When a business owner is looking to exit and they've engaged a consultant, a broker, somebody to help them go through that process, which obviously we believe in strongly, getting the right assistance when it comes to that, because it's an arduous process by itself just to weed through all of the prospective buyers that are out there. You look at what you want to try to list and sell the company for. Many people have different approaches to that. Some people believe that the value of their company is what they need to get out in terms of retirement. Other people believe that they should be able to sell it for more than what they paid for it. That's assuming that you paid the right price. So, that's why we always believe, and obviously as a valuation company, we say this not because we do valuation work for a living, but we say it because we want to make sure that you always want to make sure as a business owner that you maximize the value of the company you are trying to exit. The best way to do that is to make sure you are on sound ground when it comes to that number. And obviously that requires some assistance, both from a business broker or business intermediary that can help you establish at least some general market demand. And then from a business appraiser to help you solidify and fine tune what that value should be based on cash flow, risk, market comps, all that kind of stuff. So, when it comes to value and price, now remember from a valuation standpoint, if we stick with the standard of value known as fair market value, it's cash or cash equivalent. So you're essentially assuming a hypothetical transaction between two people who do not need to buy or do not need to sell. It's strictly based on as is condition under current financial performance, under current management, cash or cash equivalent at that point. So there's no financing, there's no deal terms, no nothing. Somebody's going to come and cut you a check and that's going to be it. So that's value. Price is different. You can take the value at that point and you can factor in other things to make the deal more attractive to a prospective buyer. Obviously, financing comes into play, whether that's owner financing or SBA or lending, SBA lending or leverage. So when you look at just straight deal terms, you might factor in that as a basis of either increasing or lowering the sale price. You look at other things like if the owner of the company also owns the property, they may want to give you that property at rent-free for 2 years just to make sure that you're able to make your debt service to them. If you're owner financing. So there are a lot of deal terms that an owner will make to a prospective buyer to make the deal more attractive to them, which may influence the value. So you might find that most of those deal terms are going to inflate the value a little bit. So if you're looking at $1 million in terms of fair market value, but you've got an owner who's willing to give the buyer 2 free years of rent on the property, access to certain types of equipment that they don't have to buy, and other types of sweeteners just to get them in the door. That $1 million value now may turn out to be something more like 1.3 million or 1.4. And if you finance it over time, obviously it makes it a little bit more palatable. So to me, I don't like to try to make it too complex. I think when it comes to the discussion of price versus value, value is cash or cash equivalent. Price is really going to be deal terms based on that value to alter what those numbers look like. And I think if you just think of it that way, that really is the main difference between the two.
Yeah, almost like a timeline, if you will, of like values today and obviously done through cash or cash equivalent, and then without the understanding or knowledge of who might walk in the door, so to speak, and
Sure.
what that construction of a deal might look like.
Now, I will add one more thing to this conversation because it does come up a lot. I've referred to primarily in our discussion the standard known as fair market value, but there is another term in valuation called investment value. And investment value is essentially a vested interest in the acquisition of the target company, meaning that the buyer now has a compulsion to buy for a specific purpose, for a specific return on investment. That buyer could be somebody that's looking to acquire a new customer segment, a new market, a new product or service. Those have strategic value to a specific kind of company. So now you're looking at strategic value instead of market value, fair market value. And sometimes that does come with a different approach to establishing the price of the company. And in some cases, that price and value may be the same thing. It does differ from one business or one person to the next based on synergies, economies of scale, return on investment. So in order to be able to determine what that strategic value is to a seller of a company, you got to know the buyer first before you can determine that, because every buyer is going to be different. And the qualities of what they're looking for and the characteristics in the business they're looking at may be different as well. So you just got to keep that in mind.
Yeah, no, thank you. All right, great. So let's discuss, perhaps a little bit of transition onto kind of from the business owner's view, let's discuss maybe the reasons why they should get evaluation performed and, why it's important.
Well, I think as a business owner, we always make the phrase that the business is most likely to be the owner's most valuable asset. In some cases, it may not be all the time, but in most cases it is. Protecting that asset obviously is your number one priority, and the ability to determine a benchmark for planning, for growth, for exit is always a good idea. You always want to make sure you kind of have your finger on that pulse of where the value of the business is today. Do you need it to be at a certain place in the future? And if so, when? And then if so, how do you do that? So there's always a reason for an owner of a business to have a business valuation. And in many cases, it's not just the idea of exit. There are lots of other life events that happen to a business owner over the course of their ownership that require a business valuation. So you look at the obvious, which is exit, but others can be things like key man insurance, employee stock ownership. If you have a company that's large enough to be able to sell to your employees, it's a very popular vehicle for business owners to do that. Maybe you're going through a divorce. Maybe you want to start gifting some of the stock of your business to your children or to other family members. There's lots of reasons why you may want to value business. Say, gifting an estate or another reason. So there's a handful of you'd be going through an argument with a partner, a lawsuit or partner dispute, maybe another reason. So a corporation status changes. You're moving from S corp to C corp. As another reason. There are lots of different reasons why you would want to do it. And every reason has a specific purpose, which has to be identified in the business evaluation too. So when you're looking at these different reasons or purposes, the appraiser is going to identify that purpose as part of the valuation. You can only have one. And the approach to value may be different from one to the next. So when you're exiting, you want to maximize value. When you're gifting, shares of stock, to your family, you may want to minimize value. You want to be a little bit more conservative, and a good appraiser will identify, how to do that lawfully and reasonably without throwing up any red flags to anybody who may want to take a look at that. So those are a lot of the most common reasons that you might find.
Yeah, no, for sure. And I think you made a good point of like always a responsible thing is to always kind of, have your finger on the pulse of kind of understanding at least, for whatever life throws at you, kind of where you stand or where the company stands. So no, that's important. So in order for a business owner to carry out this process, what, I guess, maybe at a high level, I'm sure there's a lot, but maybe you could touch on at a high level what's kind of required on their end to do this. Like, I feel like a lot of people probably just say, don't have their finger on the pulse, and let's say specific to selling or exiting, they're like, I don't even know where to start. So kind of maybe walk through briefly just kind of the process and what, I guess, heavy lifting is required on their end.
Sure. Well, I think going back to the key components of value, obviously you're identifying two things: cash flow and risk. There are others, obviously, but those are the two key factors and areas that anybody's going to ask of the business owner to start focusing on, right? So when it comes to risk, you want to make sure that you understand the true operation, what it entails, who's running it, how many people do you have, what kind of products and services are you selling, what your customers look like, what your suppliers look like, and vendors, where all of your relationships are, your facility, whether you own it or lease it, and what the terms are of that, and do you need to be there. So obviously your basic operational stuff, which most business owners can rattle off in about 15 or 20 minutes. Then it comes down to the financial strength of the company. And obviously when it comes to the financial side, you're looking for 3 full years of financial statements. Some will go back as far as 5. I would tell you that at this stage, our economy changes. It seems to change every 1 to 3 years. So, what you looked like 5 years ago probably isn't any indication of what you look like today. So 3 years at least, a year to date interim statement, P&L balance sheet with a previous year comparison, so we can see what you're doing now versus what you were doing at the same time last year. In addition to that, any discretionary or non-operating expenses being funneled through the income statement, you want to be able to identify on a year-by-year basis. We need to be able to see where, not only what they are, how much, but where they're being expensed at. So that right there is probably a lot of the heavy lifting, especially if you've got a lot of those business owners that are running a lot of expenses through their company. Not uncommon, by the way. Obviously, everybody wants to reduce their tax burden. So it's not uncommon to find a lot of personal expenses being funneled through the income statement of any company. Our suggestion, obviously, if you have the time as you're planning exit, to clean up those expenses as best as you can, because ultimately what you want is a clean income statement. Oddly enough, going back to that same comparison we talked about not too long ago, if you've got two companies side by side that look identical to each other, both in financial strength and performance, but one company has a clean income statement and one company has a income statement that has a lot of adjustments to it, the one that's got a lot of adjustments to it is going to have a higher level of financial risk. So value, it goes back to the same idea. You can reduce your tax burden over time, but when you get ready to sell, if you want to truly maximize the value of your company, you've got to clean up your income statement. You can't do both. So you're either going to pay for it prior to or at the end, however which way you want to look at it. So I think, to me, the heavy lifting is going to be identifying a lot of that detail in the financial statements that anybody's going to want to see, because not only is the appraiser going to want to look at it, all of the potential buyers of that company are going to want to look at it as well. So, beyond that, I would say that as long as any business owner has access to that information, that's most of them will have access to it readily, either through QuickBooks or some other form of internal financial accounting software. Most business owners should have ready access to their tax returns for the last 2 or 3 years. It's hard not to believe that they don't. So when it comes to the list of things that anybody's going to ask, you could probably spend a half a day putting together all that information. You should be done with it. So you just have to find a time for it. That's all.
Yeah, no, for sure. And you bring up an important point, which I think is like many business owners, don't reflect the business's true earnings as a way to shelter or reduce their tax burden, like you were saying. Maybe you could give some of the common, I guess, expenses and how the best way, if an appraiser like yourself is looking at it, you're looking at the company for the first time. Obviously you don't know the ins and outs like the business owner does. Like maybe there's assumptions that are made. Oh, well, I do this and it's in this category. Like what exactly? Of course, you need to understand, what it is, how much it is, and why they consider it to be, not essential to the company. So maybe you could just touch on that.
Sure. Well, we all know that most small business owners are looking to try to maximize their income as best as they can. So you'll find that they may take a small W-2 salary. Other forms of non-W-2 income could be consulting fees or management fees that they'll run through as an expense. Pretty common to see that. Those who own their own property may be inflating rent to themselves or to the company that owns the real estate to shelter some tax there in terms of income. So you'll find that typically those are the most common ways for a business owner to increase their income. In addition to that, they'll pay salaries to family members who don't work at the company through W-2, other forms of consulting fees. So from an income basis standpoint, those are the most common that we'll find, and they're usually readily available on the income statement or the financial statement, or income tax return and the financial statement. Other forms of what I'll call non-compensation based benefits are going to be auto expense. Most business owners are going to run their automobile expense through the company. It's a lot easier to identify, especially if you're dealing with a service-based business that doesn't require any transportation at all, like a dentist or somebody, some form of a medical practice where, automobiles are not widely used as part of their day-to-day. So those are pretty easy. Health benefits, disability, dental, eye, optometry, things, chiropractic, things like that are all run through the business. So you got your health side. Travel, entertainment are a big expense. From our standpoint as appraisers, we're looking first to make sure that we can identify how strong the business is financially. When those margins are below average, that's when we start looking for other things that are being run through the company. And usually you can find those things pretty easily once you know that you're looking for them. So, for those situations where we're seeing low margins, we're looking at staff, we're looking at, like I said, automobile expense, we're looking at health benefits. Sometimes travel, entertainment's a big one, obviously. Those are I would say the most common expenses that we see on a regular basis. You'll find others, but those are pretty regular, I think, from our standpoint.
Yeah, and what about scenarios where there's also they own the building, let's say, and pay rent? That's probably a pretty common one, isn't it?
Well, for those who do own the real estate, yeah, and obviously, going back to compensation for the owner, it's a great way to to increase your own cash flow, your own benefit. So you may own the building and you may be charging $100,000 a year in rent, where market rent may only be 20 or 30. So there are, and then you've got other companies that they may form to where those consulting fees are going to. So we've seen how all of these companies can be interconnected. So you may have an operating company, you may have a consulting company, you may have a real estate company, and all three of those companies together, owned by the owner, provide them with regular access to be able to move cash and money and expense back and forth between the companies. That being said, though, when it comes to sell the company, you've got to start unwinding those companies one to the next. You don't want any overlapping expense or income between the two. You want to make sure that you can separate them.
Yeah, and just for, I guess, for folks that maybe aren't super familiar with adjustments, I guess on a very, very simple example, how is that actually taken into account for valuation? So let's say the company, its profit is 500,000, and then they have adjustments of, I don't know, 200,000. Are they added? Are they, maybe you could touch on that.
Sure.
Basic understanding, I guess.
Yeah. So when you go back to the idea of value, I always go back to the same thing. It's cash flow and it's risk. So cash flow is that component, what you're talking about. Cash flow is not profit. Cash flow is normalized earnings. So going back to the understanding that profit or lack thereof typically is the means by which an owner is going to reduce their tax burden to lower their profitability. So the lower profit you have, the lower tax you pay. Cash flow basically incorporates all of the things that are reducing that profit. So in calculating your cash flow, which is one of the key components to driving value of that business, normalized earnings are really what you have to do. So normalizing your company's earnings, you're starting with profit. So whether that profit is a positive number or a negative number, you're adding to that interest, depreciation, amortization, W-2 compensation, and all of those other items we just discussed. Anything that's non-operating, one-time expenses. If you spend $100,000 last year on upgrading your computer systems, that's a one-time expense. That's not normal. You add that back as a one-time expense. Any non-operating employees like family members and salaries, you're going to add that back as well. Any non-operating expenses that don't survive the business, so anything that's personal, is going to be added back as well. Lawsuits and things like that obviously are not part of the normal day-to-day. You're going to take those expenses and add those back. So what you might find is, like you said, if you've got $500,000 in profit in the year in 2020, but you've got $300,000 of non-operating one-time or discretionary expenses included in that profit, you're going to add those back. So now your normalized cash flow is $800,000. And that's what that is, at least one of the variables that is being used to drive the value of the business. So you want those numbers to be as limited as possible. So ultimately, when you're selling a company, you want that profit on your tax return to be as high as you can get it. If that means paying tax for a year or two, that is the way to maximize value. Otherwise, you're dealing with a lot of expenses that a hypothetical buyer is going to have to wait out. And what I mean by that is, when you acquire the business on day one and you've made a list of all of those non-operating expenses, it's going to take you a year to make sure that those expenses no longer exist before you can realize that cash flow. That incorporates some financial risk. So going back to the same concept, if you have the time, we always suggest plan early. Start cleaning up your income statement, paying your tax, maximizing your profit, showing that on your tax return. Therefore, there's really no question about it when it comes to calculating cash flow. You should be able to really calculate cash flow off your tax return right off the front page. That's the best way to do it.
Yeah, nice. Okay. So I guess in this process, how would, I guess, assets and potentially more specifically liabilities be recognized? So, obviously, let's say in this hypothetical scenario, there's two companies that have all the same attributes, but one has a tremendous amount of debt or something to that effect. How would that be recognized?
Okay. Well, first of all, you have to make sure you're establishing what's being transferred. So let's assume for a moment that we're talking about an equity transfer, where because if you go back earlier in our discussion, most small businesses, not all, most small businesses are bought and sold at the enterprise level. The enterprise essentially makes the assumption that any hypothetical buyer of a small business is going to take just the assets, the operating assets of the company, inventory, furniture, fixtures, equipment, vehicles, and transfer them into their own S Corp. The S Corp is obviously the key target there because they're limiting tax liability. So in the enterprise level, you shouldn't deviate from that at all. But these days you'll find that an enterprise level transaction can in fact be equity, where it represents all assets and all liabilities. So you want to make sure that you understand what's transferring. But let's just go with the traditional form of, the asset / enterprise value versus the equity value. So going back originally to asset and enterprise, inventory, furniture, fixtures, equipment, cash flow, goodwill. is the basic transaction structure there. Equity is going to be those same assets plus the remaining cash, receivables, and other assets, in addition to all of the other liabilities. That would be payables, short-term debt, long-term debt, and other liabilities. So when it comes to the value of a business at the asset level, let's just say for a moment that the value of a company is worth $1 million at the asset level. That's inventory, furniture, fixtures, and equipment. If you're going to sell that same company, but you're also going to incorporate liabilities or sell it at the asset or sell it at the equity level, let's just for simplistic purposes keep it to just debt, right? Interest-bearing debt. You've got a $1 million business now that has $500,000 of interest-bearing debt on the balance sheet. If you're acquiring the equity, the value of your enterprise is $1 million. The value of your equity is worth $500,000. So essentially, you're taking the enterprise value and subtracting any long-term debt from it. So the difference between the two in a traditional format is going to be liabilities are a subtraction from value, assets are an addition to value. So in retrospect, when you look at the difference between the both, all things being equal, if you've got more liabilities, obviously that's going to detract from the overall value of the company.
Okay, great. And you mentioned goodwill. How are kind of the intangible, maybe you could quickly define it, and then, how are kind of more intangible items looked at, brand value, patents, software, stuff like that.
Keep in mind that any of the intangible values, the assets that you just mentioned, should have a direct impact on the company's financial performance. Keep that in mind. So when you look at it from that perspective, you're making the assumption that the ownership and acquisition of those assets or the innovation and creation of those assets are having a direct impact on the company's ability to grow and to outperform compared to its competitors. So when you take that in that context, you're making the assumption then that you should be performing better as a result of ownership of those assets than your competitors are without them. In that context, you're looking at the value of a company that is incorporating those particular assets. So goodwill is a byproduct of your financial performance. It either exists or it doesn't exist. So if I'm looking at a company that's generating $500,000 a year in normalized EBITDA, and I know that 4 times that number gives me a value of 1.6 million. That 1.6 million is inclusive of all of those assets. That's inventory, furniture, fixtures, equipment, vehicles, and the items that generate the revenue that generates the cash flow that drives that value. So it's not like you're going to say, yeah, my cash flow is worth 1.6 million, but I've got these intangible assets that I want to tack on at another $1 million.
Yeah,
it doesn't work that way. So assuming that those assets are being transferred with the company, the cash flow that they generate is the basis of value. Therefore, the value is inclusive of those assets. So really, if you want to make it as simplistic as possible, the value of the intangible value of a company simply is just a calculation. Obviously, this is oversimplistic, but I think for people to understand, it's basically total value minus tangible value. So if I've got total value of 1.6 million and I've got tangible value of 500,000, that leaves me with intangible value of 1.1 million. That is goodwill. Okay. That is goodwill. You can divvy it up and carve it up any way you want to. The appraiser is not going to say, the patents are worth this and the software is worth that and your employee base is worth that and your customer list is worth that. It's just that you can allocate it any way you want to. But that really is what goodwill is. It's just intangible value, and you can carve it up any way you want to.
Yeah. So in other words, like if you have a patent, let's say on a product that has never generated a cent to your company, it's like, in the words or in the view of the buyer, they're like, well, it's not woven in and folded into the fabric of the company. In other words, no.
Right. You could essentially acquire the business at that point and not have the patent.
Yeah.
And probably do just fine. The other side of the equation, though, is that the common question here on businesses that, going back to the cost approach for a moment, those businesses that are valued based on the cost approach, where you've got an abundant amount of assets on your balance sheet and only a small amount of cash flow. If you're valuing the business at 1.6 million, and that value is based on inventory, furniture, fixtures, and equipment that are worth 1.6 million, you've got no cash flow value. That means that your total value minus your tangible value equals zero. There's no goodwill there. Yeah. Doesn't mean you're not a great company. Doesn't mean that you don't have great products and don't have great people and don't have great customers. But in the true definition of goodwill, you just don't have enough cash flow to support a value that's higher than the tangible assets. So in those cases, the byproduct of low cash flow generates zero goodwill. You need cash flow in order to generate any goodwill at all to start.
Yeah, that's a great way to put it in that, and thank you for that. So this next section, we're just going to basically, I think there's a lot of misinformation out there, and I think it's good to clarify some of these questions, or call it myths. So we're going to hit you with a little rapid fire, maybe true or false, and then if it's false, briefly describe why that's the case. So
got it.
Number one, I only need a valuation when I'm selling my business.
False.
Okay. Yeah, we touched on that a little bit earlier.
Yeah, lots of reasons why you need a business valuation, not just for selling.
Yeah, for sure. A local competitor sold his or her business for 3 times cash flow 6 months ago. My business is worth at least this much.
It depends. So that goes back to the question of how comparable you are to your competitor. So using the example we used earlier, if you've got an abundance of risk, whether it be in customers or vendors or dependence on an owner or something like that, and your competitor does not, then you're not worth 3 times cash flow.
Okay. Every business is different and requires its own valuation.
Yes, that is true. Every business is unique in their own way. And even if you're comparable to your competitor or somebody down the street, you may be better in certain areas that may provide you with a little bit more value.
Okay. A business that loses money isn't worth anything.
Depends. If you define losing money as negative cash flow, I would say that's still false, because if you have any assets at all, you can sell those assets. Right? There's always a value to hard tangible assets. If you're talking about losing money in terms of unadjusted profit, there's likely some adjustments to the income statement that you can make to generate cash flow that could provide some value.
Okay. A sound valuation can be done with 2 years P&Ls and 2 years balance sheets.
I would agree with that. Obviously we're looking for more information. If that's all that is available, any qualified appraiser can work with that. Any qualified appraiser can work with 1 year. Obviously there's some risk there, right? The less history you have, the less information there is to look at. But you could do an adequate valuation, sound valuation with 2 years.
Okay. I know my business. I know what it's worth.
That's a hard one. I think most business owners know their business very well. Most business owners are not business appraisers, nor are they educated in what drives value. And I think that's really the difference between the two. There are some, but most don't.
Okay. A business valuation result will vary on who appraises the company.
Obviously, when you're dealing with the two key principles of value, which are cash flow and risk, everybody perceives risk differently. You're never going to find 2 people to value the company identically because of that reason. Everybody perceives risk differently. Everybody considers valuation approaches and methods just a little bit differently. Qualified appraisers with the appropriate credentials are going to value the company very similarly, which means that the value should not deviate too much within a few percent of each other.
Valuations of large firms don't apply to me if I'm a small business.
I would agree with that. Large companies have different characteristics. They may have less dependence on ownership. They may have greater access to capital. They may have access to better or larger markets, larger customers, larger regions of customers. So I would say that small businesses certainly differ from their larger counterparts.
Okay. Businesses can be valued based on potential.
If you're looking at the value of a business from a strategic standpoint, that's certainly something that's taken into consideration. With that said, anybody who's buying a company based on those principles is not going to pay for what they are going to do once they acquire it. There may be some marketability as a result of that company being weaved into another operating company that makes that company a little bit better. But pure potential is not something that a buyer is going to pay for, because that eats into their return on investment. So I would say there's some truth to that, but largely not.
Okay, great. So this concludes the interview portion or rapid fire portion of the discussion. So now we're going to actually receive a few social media questions from a poll that we put up there. We actually got a ton of people, so thank you to everybody that submitted, and we did have to kind of select the ones that we felt were potentially the most on point, but all of them were great. So at Bia Venturini asked, during due diligence, how can the business buyers guarantee or attest that the price of the business is accurate or true?
Well, as a buyer, your due diligence is your due diligence. So you have to be responsible for that. As an appraiser, my responsibility is to identify any red flags that we see in any of the information that's being presented to us. We're not auditors, nor do we audit. So we are accepting the information being provided to us as and under the assumption that it is factual and with no deviation to that fact. So, when it comes to a buyer and their due diligence, as long as the information is correct and there's no deviation from it, then the value from any accredited appraiser is a qualified opinion.
Okay, great. At Brian Yale asks, has COVID impacted the value of businesses? If yes, how? And is there anything that business owners can do to regain any value lost from the impact of the pandemic?
Well, the quick answer to that is yes. COVID did impact just about every business in the year 2020. Some businesses did perform better than others, but for the most part, if you just consider the idea that most businesses had to endure at least a 1 month, possibly 2 months worth of restricted or shut down to their operation, their revenues and their profits clearly were impacted. With that said, if those businesses have been able to regain all or most of that performance once that lockdown was lifted, and they are showing year-over-year performance now that is close to or at pre-COVID levels, the impact of 2020 is going to be very limited, if anything. So there are some businesses that are showing that right now. They were down for a couple months. As soon as they reopened, they regained all of their customers. The demand was there. It's like nothing ever happened. The ramp up time was very, very, very small. Others obviously are not that fortunate. They're still struggling a little bit. So it's based on the industry at this point. But the owners should, what I try to tell owners that I talk to is do your best to try to identify the rebound. So if you were down for a couple months, show that rebound and do your best to try to make sure that progression is showing an upward trend. If you can do that, at some point you will regain what you lost and you should be in good shape.
Okay, and this is kind of an add-on. This is not one of the questions that was submitted, but I guess how do you classify how, we're talking about adjustments, a lot of small businesses took what's like the PPP loans. Would that be something that would be considered a one-time? Should they, gradually progress back in an upward trajectory? They've kind of weathered the storm, so to speak, and the money that was spent on that, on those expenses, whether it be PPE, whether it be paid sick leave, so on. Maybe you could just discuss the dynamics of that.
Well, PPP loan or really anything involved from COVID relief is considered a loan from the federal government. That's all it is. It's just a loan. It could be a loan, if you consider the same idea, a loan from a shareholder or a loan from a family member, it's just a loan. So that is booked on the balance sheet as an increase to cash and a decrease to liabilities. or an increase in liabilities as well. So ultimately, once that loan is forgiven, it goes right off the balance sheet again as zeros. So the income statements should not reflect that as income. Any expenses being paid from those proceeds should not be added back as an adjustment to cash flow. It's simply a loan and a cash injection to keep the business afloat. So as long as you're using those funds properly and you've been able to stay afloat the best you can, all you're trying to do at this point is to show that progression and that positive improvement on a month-to-month basis.
At WKnox_biz asks, I'm 58 years of age and want to exit my manufacturing business in the coming years. I've recently promoted a long-time employee to a decision-making position, and I've been spending less and less time in the business to make it more turnkey. All else equal, what other things can I do to maximize the value of my business?
Right there. I mean, that's a pretty good one. Removing the dependence on ownership and moving that to a key employee, especially a key employee that may end up actually buying the business, is a good thing. The elimination of dependency of ownership is a pretty big risk by itself. So selling a company as absentee owned is very attractive and helps to increase the value of the business. Other areas we've already touched on. The only other thing you can do at this point is to clean up your income statement, make sure that your tax returns are fully maximized, you're paying your tax. And if you can do that and eliminate any other risks, whether it be key customers, key vendors, I think you're definitely on the right path there.
Okay, awesome. So that actually concludes the social media Q&A. And again, thank you to everybody that submitted. Obviously, we're not unable to address every single question, but your participation is appreciated. Darren, I'd like to end by seeing if there's anything that I neglected to ask, or if there's any messages you'd like to share with the audience.
No, I think we've covered everything, and a lot of the questions that you were asking, and some of the questions from the group are all common. As an appraiser, we've seen just about every question that's out there in just about every scenario. So we certainly appreciate sharing the knowledge and expertise that we have in our 24 years of business, and at the same time, our family of companies through GCF is committed to helping small business moving in the right direction. We're very passionate about entrepreneurship and small business in general, and we're certainly happy to share our knowledge and expertise with everybody here. So we appreciate you having us on. Awesome.
And where can people find you online?
If you go to gvalue.com, that's our website. You'll be able to learn a little bit more about what we do, not only on a valuation side, because we've got 4 companies. We've got GCF, we've got the Business Valuation Unit, we've got Peer Comps, which is our transaction database. We've got Banker Valuation, which is a valuation tool for lenders and underwriters, and we've got FinVal, which is valuation tools and consulting for financial advisors. You can learn more about all of those companies at gvalue.com. And if you have any questions, you can just connect with us right there.
Great. And I'll definitely have your information in the show notes below. So this has been a ton of fun. I think that we put a lot of unknown scenarios to rest. And thank you so much for carving out the time to provide the insight on today's topic. Thank you so much.
It's been my pleasure. Happy to do it. And anytime you want me back, we're
ready. And lastly, thank you to everybody that is tuning in to today's webinar. If you're looking for more information around buying and selling private companies, check out our tools, resources, and blog at Tresle.com. Further, if you have any suggestions on future webinar topics or guests, drop us a line, email at hello@Tresle.com. Thank you guys so much, and stay safe.